Hello, this is Tyler Moore from the University of Tulsa. Today we're talking about information risk management. Two main topics. In this first video, we'll talk about how risk management works in general and frame it in terms of information security problems. And in the next video, we'll talk about frameworks. So we've already seen in this course how it's useful to calculate these security metrics and investment metrics, which are essentially taking traditional business terms like return on investment, net present value, and then sort of using them for the purpose of understanding security investment and helping to guide security decisions. And so in the same vein, it's important for us to be aware of the terminology from risk management and think about managing information risks in the broader context of how organizations manage all of their risks. This is increasingly important because cybersecurity is very much top of mind for many businesses now, and so they're elevating its importance, which means that you have people at higher levels of the organization who want to talk about this in a way where cybersecurity is treated as any other risk. So how do we do that? Well, here's a high-level overview of how risk management works in general. Well, the first step is always supposed to be risk analysis, where you identify the different risks that the organization faces and then quantify that risk. So quantify both its potential impact if an adverse risk were to be realized and the probabilities that or likelihood that such a risk will be materializing. So you do that first, ideally collecting some data on what the risks are and their likelihood and impact, and then you go into the risk management phase, which is sort of the heart of the approach, where you then either accept, mitigate, avoid, or transfer your risks, usually a combination of those. Now that you know what the risks are from the analysis, you can then manage them. And then there's a risk monitoring stage at the end where essentially you have a process that's in place and you want to validate its effectiveness and document to the extent that it works and aligns with your expectations of what the risk should be. And risk transfer is also, in our case, referred to and provided by cyber insurance. We'll talk about that later. So each of the four main categories of risk management. First is risk acceptance. So this one, in a lot of ways, is the easiest. Simplest thing is to do nothing. If you just accept a risk, then you are making an explicit decision that, for whatever reason, the risk that you're considering doesn't require any security control or any sort of active steps to reduce the likelihood of that risk impacting your organization. So when would you just throw your hands up and accept the risk? Well, usually happens in one of two ways. Either the worst case loss is so small that you can just pay from your ongoing proceeds and just treat it as a cost of doing business. Alternatively, if the probability that of an occurrence is so small relative to other business risks, then you would focus on those other business risks first. So it's easy to think of us, as sort of working in IT and thinking about cybersecurity, that it must be the most important risk an organization faces, but that may not always be the case, and often isn't. There are lots of other business risks, which in some cases could take precedence. And sort of the extreme example of this is think about like a startup firm. It would be nice if you had good security practices at your firm, but there are other business risks that may be more pressing, like being able to even meet the payroll or ensure continued funding of your company. Because if you can't continue to get funding, then there won't be any resources left to protect from a security risk. So as a result, it's often the case that these sort of smaller companies that are in the early stages will have lax security policies, if they have them at all, compared to more entrenched larger firms where they are sophisticated enough and mature enough that the cybersecurity risk becomes a higher priority relative to other business risks. If a risk is too big and too probable to be accepted, if you decided that you can't accept the risk, the next option is to mitigate it. And risk mitigation reduces the probability and severity of a loss. So this is where most security investment comes in, where you're deploying a security control which can mitigate a particular risk. So it's not to say that you can mitigate all risks or that you would even want to. So if we go back to our security investment models, we can see that there is usually some residual risk that is left over. So you will mitigate until you get to the point where your marginal benefit from added security is equal to the marginal cost, at which point you then can accept the remaining risk or use a combination of acceptance, avoidance, and transfer. So avoidance. So it's related to but different from mitigation. So it's also trying to reduce the probability and severity of loss, just like we see with risk mitigation. But unlike in mitigation, where you actually will deploy a control or spend money to try to reduce the expected losses, with risk avoidance, you simply forego risky activities. Now this in turn creates opportunity costs of lost business opportunities. So let's go from some examples. So first of all, you have an online merchant that's maybe refusing overseas orders because there's just an unacceptably high fraud rate of international ordering, and it's difficult to reclaim losses. So an avoidance strategy would be to just not accept them at all. Contrast that with a mitigation strategy, which would be to provide some additional screening or control to try to screen out the more risky transactions. That would be a mitigation against the international fraud risk. But the simpler case here is just to avoid it entirely by foregoing those transactions altogether. Another example, so a company may have valuable personal information that they have on their customers, and if they'd like to make this, they could make this available through a website portal, and doing so provides benefits to customers, but at the same time, it also introduces some risks. And so a risk avoidance strategy would say, look, it's too risky, we don't want to lose valuable personal information, so we're going to keep this database offline and not make it accessible, which again also introduce opportunity costs. So we've talked about risk acceptance, mitigation, avoidance. The last category is transfer. And this is another word for insurance. So you can buy an insurance contract to recover losses. So you take your risk, you buy an insurance contract which transfers the risk to the other party. In cyberspace and IT risks, there are just a limited set of circumstances in which you can buy a cyber insurance contract to transfer your risk. And so it's often the case that people coming fresh to the cybersecurity problems will point to risk transfer and say, well, we should be able to insure against this risk and transfer the risk on someone else, and that can be their specialty of dealing with it. Well, it's just not so easy because it can be very hard to quantify your losses, first of all. And so if you can't easily quantify your losses to a cyber risk, then it becomes even harder to convince a third-party insurance company that they should be the one to take that risk if you can't credibly convey what the dollar loss would be. And even if you could, let's say you could identify what your dollar exposure is, if companies are given the choice of whether they should disclose this to their insurance company and then potentially suffer the reputational damage of this information getting out in the public, or they could keep quiet and then pay the direct cost themselves and try to avoid the reputational costs. Many will choose to the latter, to just keep quiet. Then, as we've discussed in this class, there's externalities where if the costs of insecurity are borne by others, then you don't need to buy cyber insurance if the harm is actually being felt by somebody else. And then finally, there's a big problem with correlated risk. So, if everyone is running the same version of an operating system, and it has a common vulnerability that would lead to a correlated failure or correlated loss event, this becomes really hard to insure. So as a result of all of these things, you find that cyber insurance contracts tend to be very narrowly written. All right, so let's finish up by discussing how one example of how a company might use all the different aspects of risk management to deal with a security problem. So we have a credit card issuer. So this is the bank which issues your credit cards. Citibank being a big example. They regularly have to manage card fraud, and they do this using a combination of avoidance, acceptance, and mitigation, and in some cases transfer. So what's an example of risk acceptance in this case? Well, the fraud can be paid from the payment fees charged by the merchant. So credit card issuers just know that there's going to be some amount of fraud that they can't easily mitigate that gets through, and they accept that as a cost of doing business, and then they just pass along those costs through transaction fees. But they don't accept all risk. They do a lot of mitigation. There's a lot of investment in anti-fraud technology, and trying to look at patterns of transactions. If any of you have ever received a phone call or now text messages saying that there's been a suspicious activity reported on your credit card account, that's an example of a mitigation control that was being invested in by the card issuer. Risk avoidance is another way that this can be dealt with. So, say downgrading high-risk card holders to say debit card only, to deal with a higher default risk, or in the case of fraud, so requiring online verification of all transactions, not just allowing people to communicate the number, say, over a phone. But the problem with that is if you're going to prevent these high-risk activities, then you're going to lead to lost business and lost revenue. So there's typically a limit to how much risk can be avoided. Finally, transfer, you could say structure consumer credit risk and maybe sell it on the market, so to get somebody else to take on that credit risk. This basic approach was highly used in the early 2000s for consumer debt, particularly related to consumer mortgages, and that was one of the key contributors to our financial crisis. So there's certainly a limit to the extent that you can transfer these risks. So that concludes our discussion of sort of the risk management approach to information security, and we'll continue in the next video looking at frameworks.